Let's go.
Talking with Financial Times global finance correspondent Robin Wiggle.
All right, today we're gonna be talking about ETFs. So you guys know, I stress ETFs because they have outperformed. They outperformed the market, man. Just being able to invest in the whole market itself, depending on which ETF you choose, is definitely statistically better. So if you want that set it and forget it feeling and not have to worry about picking a stock, ETF is the way to go. It just has it's that just slow growth, nothing. It just has that steady climb. You see what I'm saying? So these guys are gonna hit on it, and it is something very important. We're gonna go through it. Yes, it is 24 minutes, but this is something very important for some of y'all. If y'all looking to investing, this is definitely one of those early state. Like I'm not in any ETFs yet, but it's going to happen. But here y'all go.
Wigglesworth out with a new book, Trillions: How a Band of Wall Street Renegades Invented the Index Fund and Changed Finance Forever, about the rise of indexing and the birth and explosive growth of the ETF business. Two of our favorite topics here at ETF Edge. But first, it's official. ProShares will be the first out with a Bitcoin futures ETF. It will be
Bitcoin and ProShares futures.
PITO, and is based on Bitcoin futures contracts that trade.
For those that are looking to see what's going on with Bitcoin, here it is.
Simeon Hyman is global investment strategist at ProShares. Simeon, this is a big day tomorrow for the crypto community and the ETF community. There's been some unhappiness that the first Bitcoin ETF is tied to a futures contract and not a spot Bitcoin contract.
Yeah.
The concern out there is
y'all listen to the difference between the spot and futures.
Significantly from spot Bitcoin. Tell us about what your research has revealed about that. That seems to be a bit of a gripe from the crypto community.
Sure. Thanks very much for having me. We'll turn this narrative a little bit on its head. First, many of the experts believe that the futures
Hold on 1 second, y'all.
is actually, if anything, a better place for price discovery than spot Bitcoin. And people think spot Bitcoin is a simple place. There are a lot of different exchanges. The prices can vary. And there's a ton of liquidity in those futures. For example, the CME futures market trades.
For those that are looking to invest in Bitcoin futures, here you go.
U.S. spot market exchange. So there's a lot of information in futures, but of course, importantly, there's regulation there too. And simply the combination of the regulated futures market.
Bitcoin already at 62 today. I don't know what it dropped at, but it was at 30 something. Now it done shot up.
For such an opportunity to get invested and exposed to Bitcoin.
Yeah, this seems to be what happens in commodity exchanges in general. It's the futures market that ultimately is the one that sets the price, not the spot market. This is true in most commodities, right? And I know Matt Hogan, who I've known for many years at Bitwise, released a report last week indicating that they felt that was the situation now with Bitcoin, that the Bitcoin futures market actually led things. So one of the concerns here has been manipulation, that even Bitcoin futures might be subject to concerns about.
Now, when they talk about, this is the one thing that they were talking about when it comes to crypto. I've said this before, way when the SEC chairman, Gary Gensler, I guess that's his name, this dude is very particular when it comes to adding crypto to the market because it could be used for fraud, money laundering, all sorts of pretty much criminal activity is what he's saying. And there isn't enough regulation yet to allow crypto to be traded fully on the stock market, pretty much. Until there is some way that they can literally regulate crypto like they do stocks, it's going to be quite a bit of time before it is on the stock market, if it's on the stock market when it comes to being in ETFs. You know what I'm saying? So
manipulation down the road. So I wonder, is there some evidence that the futures market set the prices now, not the spot market? That's, I guess, my question.
Yeah, and I think it's that the regulated aspect is a part of it. It's very difficult, if almost impossible, to try to manipulate the futures market. The combination of the CME and the CFTC is really a valuable piece of that ecosystem, and the clearinghouse mechanism makes sure that really nothing kind of funny happens in the futures market. For reference, as an example, our mutual fund that we launched, very similar strategy back on July 28th. So far through Friday, the spot market, BRR, is the Bitcoin reference rate. So that amalgamates a few of these exchanges. So it's as good as it gets, if you will. That's up 51%. Our mutual fund based on futures is up 52. And you've got the
Man, look at how much the futures shot up as soon as they found out Bitcoin futures shot up. Y'all see that? That's crazy. When then they had plans, they were talking about this Monday, actually last week or something. And if you look at the crypto folders, crypto has just been going up. Like, it's just been literally going up. And everybody kind of wants crypto to be a part of the stock exchange because they want to use it as a hedge. I've said this before. There are ways to hedge your folders depending on if you use gold or some other type of commodity, silver, platinum. But you have companies now using crypto. So I dab a little bit in the crypto, I got my little sprinkle going on in the crypto, but that's pretty much it. They say have no more than 5% of crypto in your portfolio because it's, way too volatile. So, but let them go ahead.
GBTC Grayscale up just 37. So, again, other forms
Yo,
of
what's going on, Jeff?
May not be as effective.
What's happening there, brother?
In terms of giving you a real indication of value or performing in line.
You caught it just in time, man. These guys are going to be talking about ETF basics here later on in this video.
I'm trying to figure out what's the right way to view this, other than people griping that it's not a pure Bitcoin ETF. It seems to me like this is a necessary baby step. Is this the way to look at it, a first step toward a full Bitcoin?
So how you doing today there, brother Jeff?
I'm not even sure if we look at it as a baby step, because there are advantages to the futures market in and of itself, such that, even in a world where, it sounds like a movie trailer, but if there was the opportunity to do this in spot form, there are still key advantages to the futures market itself that make this a worthy investment vehicle almost regardless of timing. That said, we're still super excited to be.
That bottom line right there, y'all see it? Does not directly invest in Bitcoin. Right there. Y'all see that, right? So, invest in Bitcoin futures contracts. Contracts, not Bitcoin. So similar to options. Right.
First and bring this opportunity, because there really hasn't been anything like it to date, to offer investors an opportunity to get exposure to Bitcoin in their regular brokerage account, and just like trading it just like any other stock.
So what's next? There's obviously a raft of Bitcoin futures ETFs that are going to likely launch within days after yours. Some of your competitors have some that are out there as well. I think we're going to see that in the next couple of weeks, but including Invesco, VanEck, Valkyrie, Galaxy, all these people, Simeon. What
Now, this is interesting, right? ProShares were the ones to do the futures first, and then you have everybody else trying to follow suit, right? But the key thing is you are investing in the contracts. Like, I'm scratching my head like, okay. So it's still going to be heavy volatile. And it's not directly in Bitcoin. Okay. Now, see, when I watched this initially, yes, I understood the futures and the contracts. It's not directly Bitcoin. But I'm interested to see how long it's going to take them before they actually allow the implementation of crypto when it comes to crypto itself, not just like the contracts and, you know, everything else that's kind of on the outskirts, because they can't regulate it. Because that's the thing right now, they can't really regulate crypto, which is what I said earlier, which is a huge issue.
What can we expect next? I know viewers are going to write in asking me to ask you to handicap the possibility of a Bitcoin ETF in the future. So there's the question. Go ahead and address it.
Yeah, I'm obviously not in a position to handicap what the regulatory environment will bring, but assuredly, you know, innovation is core to who we are at ProShares. It's the key driver that brought us first with our futures solution tomorrow morning to be traded. But look, we're watching it. We're watching the maturation and the evolution of the spot market and the ecosystem. We think these ETFs will, you know, add to the robustness of that space, and we're also watching the evolution of the regulatory environment. And if the opportunity arises, we'll certainly be exploring, you know, other opportunities to bring important and differentiated solutions to investors.
Okay. I want to turn now to our next guest, All right. I've been wanting to talk to for a long time. Financial Times global finance correspondent. All
right. Now this segment is extremely important, and I'm actually gonna go see if I can buy this book at Barnes and Nobles. I'm actually going to next time I go to the mall, there's a Barnes and Nobles. I'm actually going to go try to buy that book, because, right, what they're talking about now, a lot of you like that don't want to hunt stocks and stuff, buy them individually. This is very important for y'all to understand. Like, this is extremely important for y'all to understand, because they actually break it down by numbers. They actually break it down by statistics in why the ETFs kind of outdo the market and outdo these fund managers that get paid ungodly amount of money to kind of estimate, well, how, you know, try to time the market, as they call it. Like, nobody's been able to do that, and you're not ever going to be able to come close to doing that, you know, unless there's some crazy calculation or maybe a computer model can do. Who knows with technology? But just rule of thumb, there's no way anybody can time the market where, you know, when the bottom's gonna fall out, you know, when there's gonna be a bull run when it runs up, you know what I mean? So you could only speculate, you know what I mean, in which way a stock can go. So, but when you invest in the ETF, it takes a lot of that speculation out, because you're just dealing with the market, period. Depending on the ETF. I mean, there's an ETF for everything these days: ESG, energy, technology, you know what I mean? But what I'm specifically talking about is the broad market in general, and how investing in the broad market outperforms just picking stocks singularly by themselves. You see what I'm saying? But they explain it perfectly. So if you're looking to invest, or trying to find a starting point, or to set it and forget it, is what I always call it. ETFs to me is like a set it and forget it method. That is pretty much it. But in order to gain from it, though, you got to be in there long term and not get too sketchy when it comes to the market, whenever there are a lot of peaks and valleys, so to speak, when it comes to investing. You know what I mean? A lot of people, they just get too antsy, a lot of human factor when it comes to investing, and people end up missing out due to human factor a lot. And they explain that in here. I've said this numerous times before. You see what I mean?
Robin Wigglesworth, he's out with a new book, Trillions, How a Band of Wall Street Renegades Invented the Index Fund and Changed Finance Forever. It's about the rise of indexing and the birth and explosive growth of the ETF business. A fascinating read. Robin, congratulations on a great book. He joins us now by phone, all about people, Robin, that we know and love here at CNBC, like Warren Buffett and John Bogle from Vanguard. Now, beginning in the 1970s, index funds started changing the investment world. And then in the 1990s, the birth of ETFs further accelerated the indexing revolution. Can you summarize for the viewers why indexing and passive investing has slowly been conquering the investing world?
Yeah, hi, Bob. Thanks for having me on. I mean, two things, really. I mean, it's cost and performance. I think everybody knows about the cost side, that index funds, especially broad, plain vanilla, market cap-based index funds are just a lot cheaper, right? I mean, you can essentially buy broad U.S. stock market exposure for 4 basis points now, even for free at some brokerages. And then it's just the performance side, which I think a lot of people still don't really realize that in the long run, the index beats the vast majority of professional money managers across virtually every major asset class.
All right, you heard what he said. Y'all heard what he said. The index funds literally outperform money managers, meaning if you are paying a financial advisor to maintain your portfolio and they are individually stock picking and trying to pick the best stocks for your portfolio to give you a certain percentage annually, even then the index funds outperform that. And he's going to explain why. This is why it is crucial. Like for some of y'all, if y'all don't even understand stocks or don't even want to get into it, y'all just want to invest, ETFs are the way to go. I hate to say it. Me personally, like I said before, I am in, I'm singularly picking stocks, but I'm going to get invested in an ETF here within the next few years. You know what I mean? I want to have a few stocks here and there and still diversify myself. You know what I mean? So,
I mean, in areas like equities, we're talking 90%, but still in fixed income and high yield,
90%.
fund managers still can't be in the index in a 10 or 15-year performance period.
Now y'all see that, right?
You know, it is rather remarkable of the evidence.
Y'all see that growth? Let's
a very long way.
let's go back.
Reminding people
10 or 15-year performance.
All right, y'all see that growth from 2017 all the way to 2021. If you just invested that for that whole, like, this is what ETFs do. They continually grow with the market. Yes, they will have their dips, as you can tell there in 2020, obviously. But even if you bought the dip, look at that growth. And yes, they do pay dividends. These ETFs, and I'll show you guys at the end of the video, but I'll just show you two of the classic ETFs. This is one I'm going to show, and the other one's the Vanguard, which he talks about, Jeff Bogle, I believe. And they give a heavy background of like how the ETFs developed and kind of like what to look for and why the human factor is such a devastating factor when it comes to, you know, investing, especially stock picking.
Period.
You know, it is rather remarkable of the evidence here. You know, indexing goes back a very long way. I keep reminding people the Dow Jones Industrial Index started in, 1896 with 12 stocks in it, I guess. But modern indexing didn't really start until the S&P 500 was updated in 1956. And what's interesting, and you talk about this in your book, there was a real problem calculating indexes prior to computers. How do you calculate 500 stocks in an index when you don't have a computer around? It was a real issue just doing this.
No, I break out in sweat just thinking about the work that people had to do this back in the day. I mean, when they first started at the University of Chicago to try and find out what the U.S. stock market returned in the long run, nobody really knew the answer. It wasn't until Merrill basically handed a wedge of money to the University of Chicago to find that out. They spent 4 years going through magazine clippings, spools, everything like that, and to piece together what the U.S. stock market yielded in the long run. And that was, not until the mid-'60s, really, that we really had an answer to that question. So, everything is easy today, but we forget that, we all stand on the shoulders of giants that spent a lot of work on this.
Yeah, the evidence that active managers are pretty poor stock pickers, it really goes back into the 1930s with the Coles Commission here. But the evidence...
You hear what he said? Active managers are poor stock pickers. Y'all heard that, right? You guys are about to hear the statistics behind it. The whole point of you paying these companies or money managers or whatever is to give you that whatever percentage return yearly, so that by time it's time for you to retire, you have that amount. But there are sometimes you won't be able to get that return. Sometimes you might have to deal with 2 or 3% less. Now, you have some people that will be like, they want to go to the best place that's going to give them the best chance of a return. But to be fair, this is why you have to invest early in your lifetime, very early, because the results statistically just outweighs trying to play catch up later on in life. Like, it literally is against you if you wait too long to invest. And like I said before, this is with ETFs. I've tried to tell people before, and I'm trying to get people to understand when it comes to ETFs. Very easy, very basic. Put your money in every month, let it roll. Don't even look at it, just let it roll.
Evidence really started mounting up in the 1970s.
They do a better
and
job
1980s.
saying certain things statistically than I will, so I let them say it.
Active stock picking is still popular as ever. How do you explain that anomaly, despite the evidence?
Hope springs eternal. I mean, it's kind of in our nature that, nobody wants to settle for mediocrity, really. I mean, this was one of the most potent attack lines of people in the 70s and 80s when indexing first started to set roots, that, who wants to be operated on by a mediocre surgeon? Who wants a mediocre lawyer? You want the best, right? And you want to be the best. So this wasn't just seen as lazy and passive. It was kind of seen as giving up. I think for a lot of people, it's still the boring thing, right? It's not exciting to say you're invested in a low-cost, well-diversified Vanguard index fund, right? That's not the kind of thing you roll out at parties and you're the coolest person there. No, you want to talk about the individual stocks you've picked, the derivatives you're trading, you're the fund manager that's managing your family's money. That's the kind of stuff that's cool. And that's just, sadly, human nature.
Funny, right? He's talking about stocks, how some people like to enjoy their life. When you're young, it's exciting. You want to kind of be out there and talk about, you don't want to talk about none of that boring stuff, da-da-da-da-da. But as you get older, you start to find out, man, certain things you got to slow down on. You got to kind of, stay steady, be more dependable. That's exactly what ETFs are. Slow, nothing flash, dependable. It will gradually go up over time. Guaranteed. Guaranteed. And this is why they say the stock picking statistically does not outweigh just being invested in the broad market in itself. Even though y'all looking at the price be like, who the hell's got $400, $300 and something dollars to invest for one share? Is why I tell you, you have places that do fractional shares. So all you got to do is just invest a certain amount and just invest that amount. You'll still be invested. Eventually, you invest enough, it will all add up to 1 share, 2 shares, 3 shares over time. But you don't have to buy, spend $400 on a share, every so often. Man, look, as long as you investing some way, shape, or form, and there's way too many forms of doing it now, don't let the price scare you. Fractional shares, just put your money in there.
Yeah, and it wasn't really until the advent of behavioral finance that we started to understand that how to scratch that itch. Bogle even had to address this issue many times, where we talked about the idea that, okay, you should put 90% of your money in index funds, but if you have to scratch that itch, go ahead and do 10% and try to pick stocks or pick funds. But he said, he made it very clear, he thought it was a pretty fruitless endeavor. So I guess the important point here is behavioral economics tells us a lot about why people still want to scratch that particular itch, I guess. You know, it's one thing to have an index, but one of the things I found amazing is nobody actually had an investable index until Jack Bogle started up Vanguard and created the first S&P 500 fund in, what was that, 1973, I guess. He faced a lot of opposition from people in the industry, and even then, there were people who thought this was a waste of time. You spent some time explaining that in your book and Jack's uphill battle to try to figure out how to get people interested in this business.
Wow. How many times have we heard that somebody's come up with an idea or something, and then others think that, oh, it's trash. Oh, it's not going to do good. Oh, well, you know, that's not the way to do it. That's not how we do it. And, you know, it's going to end up failing. Yeah. This is why you don't have Circuit City around anymore. This is why Blockbuster isn't around anymore. Because the failure to expand the mind to see what's coming, what is not there. So you know, this guy made sure he had a company that deals with ETFs, that he didn't see one on the stock market. And so he developed one. And everybody's giving him crap. But Vanguard is one of the biggest companies when it comes when it comes to ETFs. A lot of money rolls through there. This man is laughing his way all the way to the bank because people laughed at him, thought it was a joke. It's the same thing why Blockbuster didn't buy Netflix, because Blockbuster thought Netflix was a joke. Oh, it's just a fad. Now look who is extinct versus who's still in the know. You see what I'm saying? When people don't have that outside thinking, man, and they think, well, this can't fail, or, well, you know, this idea might be, you know, it's not to everybody. Who cares? It's the same thing in life. Sometimes you have to take that risk. And man, this company is just laughing all the way to the bank for real.
Business.
No, it's easy to forget now that the Vanguard 500 fund is now one of the biggest investment funds in the world. I mean, it's bigger than many standalone asset managers. It's as big as many sovereign wealth funds. But when it launched in the mid-70s, it was known as Bogle's Folly because it was such an abject failure, just a colossal failure. I mean, they thought they might be able to raise 300 million at the time, and they kept lowering their projections until they thought it might raise 20, 30 million. And when it launched, it only raised $11 million, which wasn't even enough to buy all the stocks from the S&P 500. This goes to show that sometimes, you know, from tiny acorns, mighty oaks can grow.
Yeah. You know, we know about the oceans of money moving from active to passive management, and much of it's going into ETFs. That's what we cover here on this show.
A lot of money.
Is the evidence still supportive that low-cost indexing outperforms active management when fees and expenses are taken into account? Is the evidence still there?
Yes, very much so. I mean, just recently we had the latest snapshot of active versus passive come out from Morningstar, which is one of the more comprehensive studies of this alongside the S&P Dow Jones.
Now y'all see these ETFs, right? Of course, Dow Jones, Russell, Invesco QQQ is all the high-end technology stocks. But I know the top one, SPY, that gives a dividend. The Vanguard one gives a dividend, VOO. Now there are other ETFs you can get into, but me personally, I'm looking at the star rating, the company itself, the type of the amount of assets that run through there, because like I said, once you get into the ETF, you pick a good one and you just put your money in there, you know, 15, 20 years, 30 years, 40 years down the road, you will have a significant amount of money in there. without ever worrying about what happens if this company might fail instead of individually trying to pick stocks. So,
and again shows that the majority of active managers over the last year have failed to beat their benchmarks. In some years, you might even see that number go above 50%. Some years it might be around 30%. But I think the thing to really remember is that, the data can change from year to year, but overwhelmingly less than half manage to beat the index in any given year. And then over any rolling 10-year period that you care to look at, I think the data is around 10 to 15% of managers manage to beat the index. And that's basically
right.
what you'd expect from this random chance.
Yeah, the two companies who put out the data on this, Morningstar and S&P, pretty much agree. And the most recent data came out just on Friday from Morningstar. Only of large cap fund managers, only 11% outperformed over 10-year periods. 11% outperform their benchmark. I think what's important about these new data sets is that they adjust for survivorship bias.
did y'all hear that stat? Only 11% over a 10-year period. Bruh, that's not good. So these people are getting paid whatever fees and whatever, because they're playing the middleman. When you have people saying, I want this percentage, 11% over 10 years have beaten ETFs. That is just staggering. Staggering. That just goes to show you might as well just throw the umbrella, and just cover the bases. That's if you haven't already started picking stocks one by one. But the stats are there, like they say. Stats are there.
Robin, which is something that's very important. Lousy fund managers tend to go out of business, so the funds tend to go out of business and they drop out of these indexes. So comparing them is difficult because they're not there anymore. So you have an upward bias because only the winners actually survive. And S&P and Morningstar, to their credit, have adjusted for survivorship bias. It's a very important discovery that they had over the last 20 years or so. Simeon, you're an old hand in the ETF business. You're listening to this. Your thoughts on the growth of this ETF business that we cover?
I think I'd like to just share a thought on what maybe you call kind of ETF 2.0, which we like to think of as rules-based strategies. So there are some anomalies in the market, things that are persistent patterns over time, and you can capture them in an index, but not necessarily one that's sort of a plain vanilla S&P 500. We sometimes like to call them rules-based strategies. Our flagship ticker NOBL tracks the S&P 500 dividend aristocrats, and those are companies within the S&P 500 that have grown their dividends for 25 straight years. Among the things you're capturing from that is a little bit of earnings surprise, almost.
And I think a crucial thing is that a lot of investors actually do worse than the market, not just because they try and pick hot stocks or hot fund managers, is because they typically bail when something goes wrong, or they jump on momentum. So actually, the problem with smart beta is that it can be really hard to hold through those long, painful drawdown periods, which is why, although I am convinced
and has thrown everything at indexing. First, it was un-American, and remember that, to go for the average return. I love that poster that was in your book from Luthold. Now they're saying that if too many people go into indexing, it's going to distort the market somehow. How important is individual stock trading for the health of the market, and how much passive investing can the market bear? Or is that a silly question at all? I mean, I get thrown this all the time from the active guys. It's going to take over, Bob.
No, yeah. Well, I think it's a valid question to ask. I mean, I think it's important that even though we can celebrate the boons of passive investing and index investing, you know, you'd be mad to not accept that even positive innovation can have negative externalities. I think, though, in practice, I am extremely unconvinced by arguments that the market's efficiency is being eroded by the growth of passive. Mostly because, frankly, a lot of active managers throughout history were, in practice, closet indexes. They just charged money as if they were trading actively, but, generally hugged the index anyway. I think, there are more mutual fund managers than ever before. There are more day traders than ever before. There are still more hedge fund managers in the US than there are Taco Bell managers. I actually checked that data point recently, and it's true. So the idea that somehow the market is dying, I find that a little bit fatuous. But there are other issues around passive that I think we do need to keep an eye on, at least, and not be blind to that there could be some problems here and there.
Yeah, I agree. Now, can we put any numbers on this? It's kind of hard to figure out, but how big is the passive investing versus active? Is passive investing 30% of the market? Do we have any sort of sense of this overall? It's about, ETFs are almost 30% of the volume by share volume in the United States right now, but I'm wondering about the actual dollar value.
Well, by assets under management, if you look at the investment industry in the US, passive is around half of the US equity investment universe. But actually, of course, there's lots of shares that, like Jeff Bezos owns in Amazon and so on, that don't actually trade. So if you look at the overall equity universe, it becomes a little bit different. So I've tallied up the international and the US and the global numbers on index funds and ETFs. And broadly speaking, there's around 17 trillion in various index funds, formal index funds. But then there's all sorts of in-house strategies as well, big sovereign wealth funds that don't want to pay.
All right, that's all I kind of wanted you guys to see and get through, because it is very important that y'all understand the fact that pretty much index funds outperform the market over time. They will outperform managers. They will outperform whoever you pick. They've already said only 11% of fund managers over a 10-year period have beaten the market, but ETFs have steadily made gains, greater gains. So the answer is clear. If I tell people, if you're beginning to invest, and just throw a blanket over there and just invest in the ETF and just keep doing that for 20 plus years, you will be guaranteed to have steady growth, steady value, and dividends. That's just it. What they just said just pretty much proved the point altogether. Like, literally. So, like I said, for those who are just starting investing ETFs, if you're not looking to, pick stocks and all that madness, even after all this, like I said, if you're gonna still stock pick, still get into an ETF that still broadens the market. Why not? Steady growth, easy money, no thinking whatsoever. Now, obviously, I don't throw my own stocks out there, but let's just go back and look at what the S&P did today. This is what S&P grew to today. SPY, that ETF, one of the high-end ETFs. And we're gonna look at Vanguard, high ETFs. They both give dividends. They both are great ETFs. So, yeah. But there it is, y'all. That's all I wanted to kind of really get you guys educated and seeing professionals talk about the difference between active versus passive, as you see on the screen, because a lot of people, and you heard the numbers, when it comes to equity, there's a large chunk of ETFs equity wise that a lot of money's trillions of dollars are passing through, because it's set it and forget it method. Why not? You ain't got to think about it. Yeah, you don't even have to even worry about it. Every company is covered underneath that S&P 500 ETF. If one goes, who cares? It ain't hurting you none. You ain't gotta worry about it. See what I'm saying? So, but that's it for your boy. Appreciate everybody coming through. That is it for today. But I definitely wanted to show that to y'all specifically because I know a lot of y'all have never really invested before, or you're looking to invest. There it is. ETFs, index funds. Yes, it's high, but go ahead, fractional shares. Put your $100 every 2 weeks in there and let it roll and let it just compound interest, man. Telling you. So y'all be safe. Y'all be easy. Till next time. Oh, before I get off, let me do some shameless promotion. So once again, we're going to do some shameless promotion. Oops. There we go. Some shameless promoting. I did add some new merchandise. So if you guys don't know, y'all see www.thefatstacks.com. I did add some more stuff. So if you're looking for, like I said, if you guys are looking for some anime figurine collectibles, we did add some more anime figurine collectibles. You know what I mean? We did add some more stuff for you guys that collect some figure. I will try to add more as time goes along and I get inventory. I will try to add more. Obviously, the wall scrolls. I will be adding some more wall scrolls and stuff. I did add some plush throws. These are like blankets, you know, like you throw over or sleep in, or you know, you can throw them over your couch, or you could even hang them up. They could be tapestry. Who says you can't hang up blankets to look like tapestries? I did add some more like I said, some more plush throws. We got some berserk in there. We got some, the time I got reincarnated as a slime in there. Of course, we got some black clover in there. Some Hayaku, if you guys haven't seen that volleyball anime, some Yu Yu Hakusho. So we've added a few more things here and there in the store. So make sure y'all check it out. You know, get some anime stuff for a Christmas gift for, you know, somebody who's heavily into anime. So, but there it is. Appreciate y'all. Till next time.